Hi, this is Andy Filipiuk in Toronto for the week of August the 19th. One of the strangest phenomena that I'm having real trouble grasping is negative interest rates. Every day I wake up and I see there's even more debt. I think it's about 17 trillion now of global government debt that's trading at a negative interest rate. And I ask myself, how can this be possible? Historically, when governments become less stable and their fiscal situation deteriorates, the borrowing cost on a bond goes up. But the opposite is happening here, where countries that can never pay back this debt are actually issuing bonds with a negative rate. And this makes no sense other than the fact that everybody who owns these bonds is anticipating even more government intervention to buy bonds. In a sense, you're front running the government. Now that can be a problem because last week or 2 weeks ago, we saw Argentina's currency crack. And Argentina, about 3 years ago, issued a 100-year bond that was actually well subscribed. Now, we finally found out who the big buyers were. It was PIMCO and Templeton out of the US buying a 100-year Argentinian bond. And I thought, my God, that's the craziest thing you could do. And it is. It's making a macro bet on something that you really don't know what's going to happen. So right now, the explanation for negative interest rates is that institutions like pension plans, insurance companies have to buy these bonds to offset their duration. But how long is it before they figure out this doesn't reduce your risk or your liabilities? It actually increases it when you're getting a negative rate on bonds. That's not supposed to happen. So I think the people who manage money are locked into methodologies that haven't completely switched to the new reality. And the new reality is such that, and I included an article that I saw yesterday on modern portfolio theory, because most money is managed internationally based on this theory that different asset classes have different correlations to one another. But modern portfolio theory that came out in the 1950s was when interest rates, in fact, nominal rates were higher than the inflation rate. So how can you use this model if we're now in a world where interest rates are negative? The correlations have changed. So I think we're going to see a whole new approach to managing money, because what we've used the last 60, 70 years can't work now, because mathematically, the way markets are priced, it's doomed for failure. So anyway, I'll talk more about this in the future, but one thing that we could see is a lot of money moving from negative yield to the US dollar, a stronger currency with a higher yield, and that would present even more global macroeconomic problems. Anyway, a long-winded video this week, but thanks for watching.